On today's Hashi, I'm discussing the new CPI report from this morning, the FOMC minutes, which were released yesterday, top markets to watch as mortgage rates fluctuate, as well as our weekly unemployment numbers. Today is Thursday, October 10th, 2024. I'm Byron Lazine, and the Hot Sheet starts now. All right, good morning. Welcome into the Hot Sheet. Let me know which market you are tuning in from. Thoughts, prayers go out to everybody currently in Florida dealing with Milton as it moves out of Florida. Absolutely, really thinking of all of you guys now, and hopefully that recovery can start as soon as today. First responders, obviously thinking about you as well in your efforts to make sure everybody is safe, and then that recovery process can start. All right, let's get into big day here. We've got CPI, and we have meeting minutes, and we got this this very interesting to me unemployment numbers that came out for this week. So a lot to chew on. BAMX members, you've got a lot to chew on with the big announcement yesterday, receiving the �𝐤𝐤𝐚𝐢𝐤 platform as now part of BAMX, completely free. You can get into BAMX today using the code ZOO for 25% off. Everybody in BAMX is getting the �𝐤𝐤𝐚𝐢𝐤 platform completely free, which enables you to bring cash offers, 4 of them, right to your seller from day one. So you can now compete with any iBuyer in your market. There's a whole bunch of other data advantages for you to educate sellers and get more listings. It's a platform. You get BAMX members get their own login credentials, build out their platform branded to them. It's a platform that will help you get more listings. And 𝐿𝐤𝐚𝐢𝐤, that major announcement we made yesterday, all BAMX members are receiving that now as we continue to build out all of the value into BAMX and why it's important to be a BAMX member. If you're an agent of change, use ZOO to get into BAMX here today. All right, let's get into the CPI report. CPI came in at 2.4% rate in September. Now, that topped expectations. Okay, that 0.2% increase for the month. The 2.4% rate is coming in year over year. 0.2% for the month puts the annual rate at 2.4. That is 1.1 rather percentage point higher than forecast. Both on the month, expectations were 0.1%, came in at 0.2. Expectations were 2.3%. On the annual, came in at 2.4. Okay, so now where we're like, whoa, he's landing the plane soft. He's doing the soft landing. He's doing it. He's the greatest Fed chairman of all time. All of a sudden now, a CPI report that shows inflation having a little bit of a sticky moment. Remember, this last little bit is going to be the hardest. It's why I came out in December in 2023, last December, saying, don't be betting on 5%, interest rates. We got a long way to go still with inflation. I talked about that on Knowledge Brokers podcast a number of times, talked about it here. Okay, so going into this inflation release from Bureau of Labor Statistics, the 2.2% increase in 2.4 annually was mostly driven by shelter once again. Okay, September increase included shelter, motor vehicle, medical care, apparel, airline fees, but shelter again being the largest. 0.2% in September matches the increases of August and July. Again, does not meet expectations. You can see still trend overall. Don't want to overstate us missing expectations here. Trend overall is still positive. Shelter came in for September at 0.2, which is a big improvement from August, coming in at 0.5. But when you go 12 months on shelter, you're sitting at 4.9. If we want to dig into shelter even more, I can do that. as we go to, it should be coming up here. Here we go. Here it is. Shelters makes up 36.5 percent of CPI. So this is over a third. Okay, over a third. That's broken up between rent of primary residence. There's a couple other smaller items, and then owner's equivalent rent of residences that made up survey makes up 26%. Owner's equivalent rent of residences came in at 0.3% for the month, and that was after 0.5 the month prior. So that's improving month over month. Rent of shelter came in at 0.2 versus 0.5 the previous month. So both month over month numbers on shelter are improving. Now the overall annual numbers are well above the overall number of CPI coming at 2.4 versus owner equivalents rent of residences annualized is coming in at 5.2. Overall shelter coming in again at 4.9 as mentioned before. Rent of shelter coming in at 4.9. Lodging away from home, so hotels, that kind of thing, is down to negative 2.8. Airbnb, whatever, down negative 2.8. Other lodging when you exclude hotels and motels, so the 2.8 would be mostly hotels. So this would be more of an Airbnb number, negative 3.7. So those are coming down month over month. We're finally maybe starting to see that data catch up in shelter in terms of owner's equivalent rent that we've been talking about for over a year. Hey, the real-time numbers on rent are decelerating. We finally saw a month over month number that showed that deceleration, still up, but did show some deceleration there. So maybe we're getting into a better place there, despite the fact that we did miss expectations. This is just the entire year over year look. On inflation, you have all items coming in at 2.4, less food and energy coming in at 3.3. That's a tick up. 2.4 annualized, still trending down, but it was supposed to be at 2.3, so still up from where expectations were. And actually, this is the not only year over year percent change, but this is going back year over year all the way to January 2021. So we've come a long way to get to the Fed's target of 2%. There is still more to do. And this is a bump in the road for, what the Fed expectations were. I mean, hey, they said inflation is working exactly to where we want it to. And now, there's going to be some questions 28 days out of their next Fed meeting, which right now CME Group is saying 13% chance they stay exactly where they are. That's up from yesterday a little bit, not much, but it is up a little bit from yesterday on this CPI data. I think it'd be up more if not for the unemployment data that also came out today. We'll cover that in just a few minutes here. That number probably be higher if it was just a CPI data release today. 87% chance that there's still going to be a quarter point cut. So that's the initial reaction here as the markets are absorbing this data in real time, just as we are. It was just released, an hour ago. So there's going to be more, obviously, analysis on this throughout the day. Maybe we'll see what the market does going into, tomorrow and throughout the day to see if there's any other, movements, and we'll be watching the 10-year and all of that. Okay. Going into your BAMX show notes, BAMX members receive these show notes each and every single day. You could download this, use this into your database. There's a whole bunch of stuff here as we get into the minutes, but you could use this for your communications with your members or with your client base. Use code ZOO to get your membership into BAMX today with a 25% off. That is only good through today as we announce that partnership with 𝐷𝐤𝐚𝐢. All right. On terms of CPI, the only other thing I'll mention here is the index, that 3.3% number for less food and energy was a 0.3% increase in September. Medical care increased 0.4% in September after previous declines. So that's something else to note. Again, motor vehicle was another big one, rose by 1.2 in September, and has increased 16.3% over the past year. and expect insurance to continue to go up as there's not a solution there. And airline fares increased 3.2% in September as well. All right, let's get into these FOMC minutes. The minutes show, and so the minutes came out yesterday for the September 17th, 18th FOMC meeting. Obviously, at that meeting, the Fed shocked some by doing a full half-point cut. Jerome Powell also said, hey, we're expected to make more cuts as we believe we have inflation under control. Today's CPI would maybe put a little small wrinkle in that statement, but the belief is inflation is going the direction that the Fed wants it, meets their expectations, and now they're ready to start cutting. The biggest factor in all of this is watching the job market. Okay, that's why last Friday, when we had that really strong job report come out with the 250,000, well over expectation, new jobs added into the economy, we saw the 10-year shoot up, 30-year fixed has shot up now. Yesterday, almost hitting 6.7 when we were as low as 6.1 right before Jerome Powell made that cut. You know, we went all the way from 8 a year ago, last October, down to basically 6% before the cut. And now we've, gone all the way back up to almost 6 3/4. So quite a swing on those job numbers. I found that puzzling because we've seen phony numbers already throughout the last 12 months on adding jobs, but the market reacts to the data it sees in real time. It's important to be able to point towards the past. We can't predict the future, that if these numbers are inflated or not. But in real time, the market is going to react, and that's why those rates shot up. But now what is interesting is Fed officials, what is apparent here in these meetings, the Fed officials were divided on whether to cut rates by a half a point in September. Minutes show. But remember, when they came out, the actual vote was 11-1. It wasn't unanimous, but it was near unanimous when they made that decision for a 50 basis point cut during that September meeting. Okay. There were some officials that in the minutes favored a 25 basis point cut. Obviously, one member voted against it altogether. So the discussion in the meeting, there was more than just one that favored a 25 basis point cut. Those votes to show unity ended up swinging with the consensus, which ended up being the 50 basis point. The only governor, Fed governor, who voted against it in the end was Governor Michelle Bowman. Okay, that was the only dissenting vote. It was notable because it was the first time since 2005 that a Fed governor opposed a rate cut. They like to show unity. We're all on the same page. We're all thinking with one brain, the 12 of us. Obviously, Governor Michelle Bowman did not play that game. Now, she may be looking like that was the right decision, where it's like now there's uncertainty if there's going to be a Fed rate cut in November. If they were certain that they were going to do a half a point, they could have said, hey, listen, we could do a quarter point here and hold a quarter point in our pocket, guarantee that in November there's going to be some type of cut, go quarter or go half. Then maybe that's what Michelle, maybe that's how she was thinking about it. But obviously that didn't happen. The stronger than expected job data at 254,000 in September has suggested this robust labor market, obviously, since last Friday. And that's got people worried that the labor market might be too strong, even though, again, earlier this year, we revised down 800,000 jobs because they were overstated. And that maybe there won't be a Fed cut in November, because if the job market gets too strong, that can create more inflation. If the job market gets weaker, that can bring on those fears of recession. Okay, just taking a look now, and we broke all this out for you, extracted the transcript, and put it into simple form here for your hot sheet show notes inside of BAMX. On when they discussed housing in that meeting. Okay. We broke down, obviously, previously all of the examples of Jerome Powell answering questions about housing during the press conference. This is what was said behind closed doors. Participants remarked that even though the rate of increase in housing service prices has slowed, these prices continuing to rise at an elevated rate in contrast to many other core prices. So, the deceleration of rents, they're still saying, hey, it's at an elevated rate, right? And yeah, rents aren't going to come down, but the deceleration of appreciation, and in a lot of instances, actually some decrease, 1% decrease in some areas, has shown, some relief there. But the rate of the rent in 24 versus 2019 is much higher. By the way, everything is going to be much higher. Okay. Just because 2%, we get inflation down to 2%, doesn't mean the milk goes back to what it costs in 2019. Milk stays the same. It's still 2% inflation. Prices are still going up 2% every single year. When inflation gets to 2%, prices don't come down. They stay at where they blasted up to and then just gradually go up from there, 2%. You might see things like gas come down, in a situation where, we're producing more domestic oil or whatever, you can see that come down, but you can also see that go up, obviously, as we've seen in the past as well. So, but most prices, most things that people buy every day aren't going to go back to 2009. Nothing really is going to go back to 2019 there. So I don't think that's, particular to housing with that comment. Here in page 7, paragraph 3, with regard to housing service prices, some participants suggest that a more rapid disinflationary trend might emerge fairly soon. Hello. Been saying that, reflecting the slower pace of rent increases faced by new tenants. The way they look at this data, and we just looked at it, CPI, it is really lagging data. Owner's equivalent rent is a poor metric to use. So they're saying, as this data starts to catch up, they wait like a year after those leases on the rent number. This could all kind of happen at once. We did see quite a big dip there month over month. This particular month, as we looked at those shelter numbers. Okay. In addition, some participants cited risk that progress toward the committee's 2% inflation objective could be stalled by a larger than anticipated easing in financial conditions, stronger than expected consumption growth, or continued strong increases in housing service prices. Okay. So, what could stop 2% inflation objective? Stronger than expected consumption growth, larger than anticipated easing in financial conditions, or continued strong increases in housing service prices. Okay, those 3 things that the Fed is looking at. Now, if we look at mortgages, particularly in the Fed meetings, rates on 30-year conforming residential mortgages and yields on agency mortgage-backed securities, MBS, declined on net, but continued to be elevated. Okay. And then the next page 5, paragraph 5-6. In the residential mortgage market, access to credit was little changed overall. It's very difficult to access credit, very different from 2008, and continued to be sensitive to borrowers' credit risk attributes. Okay. That means it's 9 times harder now than it was in 2008 to get a mortgage, to get access to capital. Credit quality continued to be solid for large and mid-sized firms, home mortgage borrowers, and municipalities, but kept deteriorating in other sectors. Okay. So those are all the mentions of housing inside of these minutes. And again, a little bit on housing, not much. I think the headline that you're going to see is that there was divide further than the 11-1 vote. There was debate further than the 11-1 vote inside of that meeting on whether to go quarter point or half a point. And so what does that mean for November? CME Group says right now it means about a 13% chance that you will actually see a no cut take place, but they're still leaning heavily towards a quarter point. There's still a lot of data. This is just one data point that we're expected to see here before, in the next 28 days before that before that meeting takes place. Here's something in the news yesterday that is actually, it's posted from CNN during an election time. So I'm really going to pay attention to it because, I think this is what I've been saying the entire year. Mainstream media tries to tell you that the economy is better than it is because they can point towards the, the stock market and those job numbers, which obviously I don't buy into those job numbers, but the market reacts to them because they revised down 818,000 just a couple months ago, looking back on the year. So the 253,000 on Friday, I just at least question those based on recent history. But this is a very fair headline from CNN. Voters think America's economy stinks. There's nothing that will change that before the election. I mean, obviously, it's hard to change somebody's mind on the economy in 3 weeks, but this is exactly what I've been talking about. The job market is booming. Inflation has come back down to earth. Americans are spending like crazy. That's what a lot of the to CNN's credit here. They're calling out what the mainstream media is saying about the economy. Oh, jobs are strong. Inflation has come back down. Americans are spending like crazy. But this article goes on to say, whatever. Voters don't care. They still think the economy is trash. Yet for the next month, every new piece of economic data will be proclaimed as good for Vice President Harris, if positive, or good for former President Trump, if negative. In reality, the data, no matter how good or bad, probably won't make an ounce of difference for most voters. The majority of them believe it's on the wrong track or weak, according to a September poll of registered voters conducted by the Harvard Center of American Politics Studies and the Harris poll. The report card that consumers care about is their daily grocery receipts, not a CPI report from a government agency. Okay. Most voters don't even follow the overall economic trends. Obviously, we do here to be able to explain what's going on and why these rates aren't coming down. When people are like, what the heck, the rates need to come down, the prices are high. We want to be able to explain that to our customers. But this is absolutely true. Most of our customers aren't following this every day. That's why we need to here on the hot sheet. But this, I thought, was a very good depiction of what's going on in terms of a consumer's mind. Like, okay, everybody says the stock market just hit a record, the job market is strong, but you know what? I'm still living paycheck to paycheck. I'm still struggling here. And until that feeling fully shifts, we've seen signs on some of the sentiment. We looked at some sentiment yesterday that it can start to tick in the right direction. But sometimes as soon as it does, it moves backwards, right? It's going to take a long time to fully flip that feeling. Now, I think there's a chance that in 25, we can flip a good percentage of that feeling the other direction, no matter even who gets in, quite frankly, because there's going to be more certainty. But right now, there's uncertainty, there's fear. The economy doesn't feel like it's working for most. And so that, to me, that headline is a bigger reason of why Jerome Powell should make another cut in November than any other reason. Most people don't feel like this economy is actually working for them. Okay, Realtor.com put out a report here with falling mortgage rates. These markets are likely to see the most changes. What are they? Metros with the highest share of owner-occupied homes with a mortgage. Washington, 75%. Denver, 72%. Raleigh, 72%. Remember, across the country, only 60% of homes owner-occupied have a mortgage. 40% don't. So these are well above, the averages across America. Virginia Beach at 71, Portland at 69.8, Baltimore 69.5, Seattle 69, Atlanta 69, Indy 69, and San Diego at 69. Okay, markets with a higher share of outright ownership could exhibit a degree of insulation from the impact of lowered mortgage rates. Notably, New Orleans stood out with the highest share of homeowners who own their homes outright among the largest 50 markets at 45.8. And so moving into that, they're at the top. Buffalo, Pittsburgh, Miami, Tampa, Detroit, Birmingham, Alabama, Houston, OKC, and Cleveland. That's the top 10 highest share of owner-occupied homes without a mortgage. And Realtor.com is saying that those markets could exhibit a degree of insulation from the impact of lower mortgage rates. Okay. So there you go. That's their breakdown on that. Realtor.com expects rates to stay in the low 6 range throughout the end of the year, with further declines potentially reaching the high 5s by next spring. These lower rates will offer some relief to homebuyers who have struggled with the high rates in recent years, likely encouraging more buyers to return to the market. And we know what that means. That means a further competitive environment. And in those markets where people do have a mortgage, they're going to want that competition. They're going to welcome that competition because they're just not sitting on as much found money, meaning they don't own the house outright. All right. Here's your unemployment data for the week, and we're going to end here. The advanced figure for seasonally adjusted initial claims was 258,000. That's an increase from 33,000 from the previous week. You see, this is an actual uptick in unemployment claims after being told Friday how robust and strong the job market is. Why now, a week later, less than a week later, do we see jobless claims at the highest level since August of 2023, right? Because we looked at job data on Friday that was added jobs, 253,000 jobs added into the economy. But if we rewind back 12 months, we know that the middle of summer, they came out and had to revise those numbers down 818,000. That was after multiple revisions throughout the 12 months. That total upwards of 1.1, 1.2 million jobs overstated being added into the economy. Most of the jobs being added, either one or two every single month, are government jobs. That's basically like, paying for your own good numbers. It's like taking the tax money and being like, oh my gosh, our economy's robust, or borrowing money, which is really what we do, and just like over hiring, or whatever the case may be. We're just ripping through government jobs every single month as new additions. Okay, so these numbers are being inflated by that, and then they're being overstated because they're being revised down. This unemployment number, to me, is actually more interesting than the numbers that have been fluffed up here in the past. Okay, and so this increase, highest since August 2023. It's a 1 week increase. 33,000 more than the previous week, but it is something to pay attention to. This, if becomes a 4-week trend, will get the Fed to react. You'll see the Fed go 100% on a cut as opposed to 87% currently if you see a 4-week trend of unemployment going up. The unemployment numbers will drive their decision further than the actual job growth numbers, because people are losing their jobs. They want to stop that. That leads you into potential recession territory. We've talked about how that happens in the past, what those indicators mean in the past. The 10-year today, off of all this news, just kind of bounced all over the place, but staying up over 4. Really kind of flat here from yesterday, but 4.07. We had data on CPI drop down, drop up. This unemployment report kind of dropping down, dropping up, and just kind of sticking there. I think it's got to work through the markets a little bit more. Yesterday, working through the market on the 30-year fix was a continuing incline here with where we're at this week. Last week ending at 6.5 after that jobs report. Yesterday ending at 6.67. So it's gone nothing but up after the 253,000 jobs were added into the economy. Our Freddie Mac 30-year fixed weekly did come out. Oh, no, I'm sorry. It hasn't come out. That'll come out today. So last week's was 6.12. That will be up, obviously, when that comes out for this week. But the 30-year fixed mortgage rate now almost back to 6 3/4. Why it was super relevant, important, and obvious to have conversations with your clients who are mortgage bound to their purchase, to be really aggressive during that 2-week period when we saw those drop. Now, we've still, we were at 8% last October. Okay. So we've still come a long way, but we can now, this is the highest rate that we've seen since July. where we're at today. I think July 31st, highest rate since July 31st. So we can erase very quickly in a 2-3 day span, all of that month of great momentum on the 30-year fixed. That's how quickly it happens. That's why it's important for buyers to be aggressive, be working with an agent who is aggressive in those moments when you're like, let's take advantage now. In 2-3 days, erased all of the gains on the 30-year fix that we had since July 31st. And now we're kind of starting over. And we'll see what happens, see how the market reacts to some of this data. Dawn says, won't these numbers go way up due to these back-to-back storms and small businesses being decimated in those areas? It's going to be interesting to see. And again, I said at the top of the show, thoughts are going out to everybody in Florida dealing with Milton. I mean, it's going to be interesting to see. I think inventory isn't going to go up as high as it was, obviously, now I think there's going to be a lot of inventory that was maybe on the market coming off. There's just going to be a lot to shake out. One thing for sure, Dawn, that's going to go up is unfortunately insurance. Most of these numbers that we're talking about here, inflation, the job data and this kind of stuff, because it's a national macro number, isn't going to be moved all that much just based on these southeastern states that were impacted by the storms. But there's a lot of people that have obviously been impacted and have a lot to deal with there. For those of you that are BAMX members, huge announcement. If you missed it yesterday, you'll be getting your credentials either yesterday or today for your cash offer platform, absolutely free by being a BAMX member. We're going to continue to add value for our members and build out everything that you need to be an agent of change, have fast fast information rather at your fingertips, the latest 24-hour news, information, courses, relevant information inside of BAMX, and now tools that you can use to get more listings. Zudilio giving BAMX members a free platform, which will be all of your branding. It's going to be your own credentials logging in, where you can generate 4 offers for every single seller. You can be in multiple offers from day one. If somebody's thinking about, looking at iBuying, you can bring that same service to them and you get paid because Zudilio partners with agents. So you end up getting paid for that. Become a BAMX member, get access to that by using code ZOO to get 25% off of your BAMX membership. We are now officially 1 week from BAM Mania, when we will be in Las Vegas, Circa Las Vegas next week, kicking it all off on Thursday, the 17th, and going into Friday, October 18th. If you have not secured your ticket yet, go to bammania.com. VIP experience is sold out, but the main event is still available. bammania.com. BAMX members, you get a special discount on your ticket. Email jill@nowbam.com for that. Hope everybody has a great day, safe day, busy week here, and I look forward to seeing you guys over on Knowledge Brokers Pod tomorrow. Obviously back on the hot sheet on Monday and in Vegas next week. Until then, toodaloo. We'll see you guys soon.